High-yield market. The high-yield market is often called the junk bond market because these bonds are rated below investment grade, meaning they carry more credit risk. To compensate investors for that risk, these bonds offer higher coupon rates. This market includes fallen angels, which were once investment grade but got downgraded, and rising stars, which are newer companies with limited credit history. While these bonds trade mostly over the counter, you can also access them through ETFs and mutual funds. But remember, the higher yields come with a real chance of missed payments. Let's look at a real-world example. Two 5-year bonds are issued on the same day. Company A, rated A, yields 4.5%, while Company B, rated BB, yields 8.5%. That 400 basis point gap is the credit spread, and it reflects the market's assessment of additional risk. Now, imagine the economy slows. Company B's bond price may fall as its yield rises to 11%, leaving an investor who bought it at $1,000 with a bond worth only about $908. Meanwhile, Company A's price barely moves. This illustrates a key principle. Price and yield move inversely. A wider spread isn't free compensation, it's a signal of real default risk that can materialize quickly. When analyzing high-yield bonds, start with yield to maturity as your standard metric, but remember, a higher YTM signals greater risk, not a better deal. Then use option-adjusted spread analysis, tracking indices like the ICE BofA US High Yield Index, because widening spreads often point to market stress. Finally, account for shorter effective durations and the fact that high-yield bonds tend to move with equities during downturns, making diversification essential. 4 common mistakes can trip up investors in the high-yield market. Ignoring default risk, treating all high-yield bonds the same, focusing only on yield, and assuming diversification always protects you. Remember that this market rewards careful research and a long-term perspective, not shortcuts.